Let's talk about taxes, specifically how the rich are taxed. It's one of the most polarizing topics out there, right? A total maze of statistics, loopholes, and really strong opinions. But what if we've been coming at it from the wrong angle this whole time? What if the real conversation isn't just about fairness, but about how the entire system is built to work? We're going to unpack that. I'm sure you've seen this number pop up in an online debate or two. It's a really powerful statistic, and it's often used to make the point that, hey, the wealthy are already pulling way more than their weight. And honestly, when you first hear it, it kind of feels like, okay, conversation over. But is that really the end of the story? Is that 40% figure the whole picture? Or is it maybe just one piece of a much, much bigger puzzle? To figure that out, we've got to dig a little deeper. So first up, let's tackle that divisive statistic head on. Before we even get into things like loopholes or hidden offshore accounts, we need to put that 40% number under a microscope. Because like any stat, context is everything.
Okay, so here's the first huge piece of context. Yes, the top 1% pay 40% of federal income taxes. But look at this. They also earn over 22% of all reported income in the country. So the reason they pay such a large share of the tax is pretty simple. They make a massively disproportionate share of the money. This tells us that 40% number isn't the whole story. Not even close. It's just the starting line.
And that brings us to a really critical distinction we have to make, which is our next section, income versus wealth. This right here is where the whole debate about taxes gets incredibly complicated, because these two things are absolutely not the same, and that difference changes everything. Think about it like this. Taxable income is the money that hits your bank account in a given year. It's your salary or the profit you make from selling a stock. That's what the federal income tax is designed to hit. But net worth, or wealth, that's the total value of everything you own, stocks, real estate, your company. And our tax system treats the growth of that wealth in a fundamentally different way. The magic term here is unrealized capital gains. Let's say you own a stock and it doubles in value. Your wealth has just grown, right? You're richer. But you don't actually owe a penny of tax on that gain until the day you decide to sell that stock. This is the mechanism that allows for what one commenter called indefinite, tax-free exponential growth of their net worth. So wealth can grow and grow completely untaxed. But what about the income that wealthy people do have to report? Well, that brings us to the legal toolbox. There is a whole suite of strategies to legally shrink that taxable income. And you can see one of the most powerful examples when you look at real estate. Let's just walk through a classic example of how this works. You buy a rental property. Now, the IRS allows you to take a deduction for the wear and tear on the building, even if the actual market value of your property is going up. This is called depreciation. So you take the value of the building itself, not the land, just the building, and you get to write off a piece of that value against your income every single year for almost 3 decades. So for this specific property, that works out to a $20,000 deduction each year. Now think about that. This is a paper loss. It can completely erase the real cash profit you're making from rent checks. You can literally end up reporting zero taxable income from a profitable property, all while the building itself is probably becoming more valuable. It's an incredibly powerful tool. So, those are the strategies that work within the rules. But what happens when people decide to just break them? Well, that takes us to our next topic, the hidden billions, the staggering amount of wealth that isn't just legally shielded from taxes, but is actively hidden from the government altogether. To really wrap our heads around the scale of this, we have to look at the work of an economist named Gabriel Zucman. He basically became a financial detective, digging through weird anomalies in global banking data to figure out how much money is being stashed away in offshore tax havens like Switzerland or the Cayman Islands. And what he found is just mind-boggling. His research estimates that a full 8% of the entire world's household financial wealth is held offshore. And in some places, like Africa and Russia, it's way higher. We're talking 30 or even 50%. And to be crystal clear, this isn't clever tax planning. This is just plain old tax evasion. And it's not just individuals either. Corporations are masters of this game, shifting their profits on paper to countries with super low taxes. The estimated cost to the US government from American companies doing this? About $130 billion every single year. Okay, so we've looked at loopholes, we've looked at hidden money, and we've talked about fairness. But what if we've been looking through the wrong lens this whole time? There's a totally different way to think about this, and it brings us to the growth equation. What if we asked a more fundamental question? What kind of tax system actually makes the whole economy grow the fastest?
for everyone.
Now, this brings us right to the classic political tug of war. On one side, you have the view that low taxes, especially on capital, are the best way to get private businesses to invest and create growth. On the other side, you have the argument that higher taxes are what pay for the public investments, like infrastructure and research, that create the foundation for that growth in the first place. But the research from an economist named Jean-Philippe Bouchot suggests a third path. He says, let's put the emotional debate about fairness on the shelf for a minute and just ask a purely mathematical question. Is there a growth optimal tax rate? Is there a specific rate that is scientifically calibrated to maximize the long-term growth of the entire economy for everybody? And the answer that his economic models came up with is completely counterintuitive. It really challenges the core beliefs of both sides of that political divide I just mentioned.
Here it is. This is the stunning conclusion from his model. Even if you start with the assumption that the private sector is better and more efficient at creating growth than the government, the tax rate that makes the whole economy grow faster is not zero. It's a specific positive number. So a certain level of taxation actually makes the whole pie bigger, faster. How is that even possible?
Well, it comes down to something called the explore/exploit trade-off. A good way to think about it is to imagine a country's economy as one giant investment portfolio. The private sector is fantastic at exploiting. It's great at finding known, profitable ways to do things more efficiently. But the public sector, which is funded by taxes, can do something else. It can explore. It can fund those really high-risk, long-shot projects, like basic scientific research that a private company might never touch, but which can lead to huge society-changing breakthroughs. So in this model, taxation is basically a diversification strategy. It forces society not to put all of its investment eggs in one basket, which, it turns out, maximizes long-term growth for everyone.
So we started this whole conversation with a single statistic about who pays what, and we've ended up here. It makes you wonder, maybe the endless debate over who's paying their fair share is actually hiding a much more interesting and maybe more important question. What kind of tax system, what kind of investment balance is actually designed to make all of us wealthier in the long run?